Michael and Daniel are both 32 years old. They both live in Dallas. They both earn $82,000 a year. They both have exactly $50,000 sitting in the bank after years of careful saving. They both want the same thing: financial security, freedom, a future where money stops being a constant source of stress. So they make what seems like the smart decision. Michael moves his entire $50,000 into a high-yield savings account, paying 4.2% APY. He tells himself it's safe, it's earning interest, and he can access the money whenever he wants. Daniel does something different. He keeps 6 months of living expenses, about $20,000, in that same high-yield savings account as his emergency fund. But he invests the remaining $30,000 into a low-cost total stock market index fund. Then he commits to investing another $700 every month. Both of them believe they made the smarter choice. They're both wrong, because the biggest mistake isn't using a high-yield savings account, and it isn't investing either. The mistake is assuming one account should do every job. By the end of this story, the gap between Michael and Daniel won't just be surprising. It'll completely change the way you think about where your long-term savings belong. And the most interesting part is that neither one of them ever lost money because they made a reckless decision. They lost, or gained, because of something much quieter: opportunity cost. Before we go any further, let's make this comparison as fair as possible. Same city, same age, same salary, same starting savings. Neither receives an inheritance. Neither wins the lottery. Neither starts a business that suddenly explodes. They simply make different decisions with exactly the same dollars. That's important because financial advice often compares completely different people living completely different lives. That's not useful. What happens when the only thing that changes is one financial decision? That's where the hidden math starts to show itself. Michael loves certainty. Every month he opens his banking app and sees interest deposited automatically. It isn't much, but it feels good. His balance never goes backward unless he spends money. There are no scary headlines, no red numbers, no market crashes staring back at him. To Michael, peace of mind has value. Daniel sees things differently. He doesn't enjoy watching the market fluctuate. Some months his investments rise by thousands of dollars. Other months they fall just as quickly. His account balance refuses to move in a straight line. But Daniel isn't investing for next month. He's investing for 20 years from now. Those are two completely different goals. And feelings and math are two very different things. Let's look at the actual numbers. Michael deposits his full $50,000 into a high-yield savings account earning 4.2% annual percentage yield. During the first year, assuming the rate stays exactly the same, his account earns about $2,100 in interest before taxes. Sounds great. Until you remember something almost everyone forgets. That interest is taxable. Unlike unrealized gains inside an investment account, bank interest is generally taxed as ordinary income in the year it's earned. If Michael falls into the 22% federal tax bracket, roughly $462 of that interest disappears to federal taxes before state taxes are even considered in states that tax interest income. So his after-tax gain is closer to $1,638. On paper, that's a 4.2% return. Sounds great, until you subtract everything else. Inflation? If inflation averages around 2.28% over that same year, the purchasing power of his money doesn't grow by the full 4.2%. It grows much less. His account balance gets bigger, but what that money can actually buy barely changes. That's an important distinction. Now look at Daniel. He keeps $20,000 in the exact same high-yield savings account. It earns roughly $840 in interest before taxes. The remaining $30,000 goes into a diversified total U.S. stock market index fund. No one knows what happens next because markets don't move in straight lines. Some years they're up 20%. Other years they're down 15%. That's reality. Historically, broad U.S. stock markets have produced average annual returns around 10% before inflation over very long periods, although individual years vary dramatically. Daniel knows his first year could easily end lower than where it started. And that's exactly why most people never stick with investing long enough to experience its biggest advantage. Let's imagine his investments earn 9% during the first year. His $30,000 grows to about $32,700. Combined with his emergency savings, his total financial assets reach approximately $53,540 before taxes on savings interest. Michael finishes the year with roughly $52,100 before taxes. Daniel finishes with more. Not because he was smarter. Not because he took a guaranteed path. Because he allowed part of his money to do a completely different job. Michael asked every dollar to stay perfectly safe. Daniel gave different dollars different responsibilities. One pile protects emergencies. The other pile builds future wealth. It sounds like a small difference. It isn't. Because the first year isn't where this story gets interesting. The real story begins when time starts multiplying every decision they made on day one. 3 years pass. Neither Michael nor Daniel changes jobs. Neither gets an unexpected windfall. They both continue setting aside the same $700 every month from their paychecks. The only difference is where that money goes. Michael sends every dollar into his high-yield savings account. As interest rates move around, his average annual yield over those 3 years settles closer to 3.8%. That's an important detail, because high-yield savings rates aren't fixed. Banks adjust them whenever market conditions change. The 4.2% he celebrated on day one isn't guaranteed forever. By the end of year 3, Michael has contributed another $25,200 from monthly savings. Combined with his original $50,000 and the interest he's earned, his balance reaches roughly $82,800 before taxes. At first glance, that feels like a huge success. His account has never gone backward. Every statement has shown a higher number than the month before. That's incredibly satisfying. But satisfaction and wealth aren't always the same thing. Daniel follows the exact same savings schedule. His emergency fund remains in the high-yield savings account. Whenever rates fall, that account earns less too. But it isn't trying to make him rich. It's trying to make sure an unexpected layoff or medical bill doesn't force him to sell investments at the wrong time. That's its job. Meanwhile, every monthly contribution after his emergency fund is fully funded goes into the same low-cost total market index fund. Markets don't cooperate. During those 3 years, 1 year delivers excellent returns. Another year is nearly flat. One experiences a meaningful correction that briefly wipes thousands of dollars off Daniel's account. For several weeks, Michael feels brilliant. Daniel wonders if he made a mistake. This is the emotional tax that never appears on a brokerage statement. The numbers eventually recover. By the end of year 3, Daniel's investment portfolio has grown to approximately $92,000. Assuming returns close to historical long-term averages over the full period rather than every individual year. The gap is now about $9,000. Not life-changing. Not yet. But notice what created it. Neither man earned a higher salary. Neither found a secret investment. Neither timed the market. Time simply rewarded one strategy differently. Now here's the part almost nobody mentions. Michael checks his account almost every week. Nothing surprises him. Daniel has learned to stop checking altogether. Because the more frequently people watch long-term investments, the more temporary declines feel permanent. That's a behavioral cost. You won't find it listed as a fee, but it changes financial outcomes every day. Let's move to year 5. Michael has now saved for half a decade. His discipline deserves credit. He's accumulated approximately $104,000 between his original savings, monthly deposits, and interest, assuming savings account rates gradually drift lower toward long-term averages. That sounds impressive. And it is. Saving consistently is never the wrong habit. The question isn't whether Michael did something bad. The question is whether his money was assigned the right job. Remember, inflation hasn't disappeared. If prices rise an average of around 2.15 to 3% annually during those 5 years, many everyday expenses become noticeably more expensive. Groceries, insurance, rent, healthcare, travel. The dollar amount in Michael's account is larger. Its purchasing power hasn't grown nearly as quickly. That's the difference between nominal returns and real returns. One measures dollars. The other measures what those dollars can actually buy. Daniel reaches the same 5-year checkpoint. His emergency savings remain untouched. His investment account has experienced several ups and downs along the way, but long-term compounding has continued doing its quiet work. His combined financial assets now total roughly $125,000. The difference between the two friends has widened to about $21,000. Now we're finally reaching the point where people start asking the wrong question. They ask, why didn't Michael just invest everything? That's not the lesson. Remember what happened on day 1. Michael wanted safety. That wasn't irrational. Emergency funds exist for a reason. The mistake wasn't wanting stability. The mistake was confusing emergency money with retirement money. Those are two completely different buckets. One exists to protect your future from unexpected expenses. The other exists to grow your future purchasing power. Trying to make one account do both jobs is like buying a pickup truck because it is fast or buying a sports car because it hauls furniture. You're asking the wrong tool to solve the wrong problem. Let's look at another number that rarely gets enough attention. Taxes. Every year, Michael receives a tax form reporting the interest his bank paid him. That interest is taxable immediately. He owes taxes whether he spends the money or leaves it in the account. Daniel's investment account works differently. A large portion of his gains remains unrealized while he continues holding his investments. He generally doesn't owe capital gains tax simply because the market value increased. Taxes are often deferred until shares are sold, depending on the type of account and investment. That difference creates something powerful. More money stays invested. More invested money creates more compounding. More compounding creates even more future growth. It's a cycle. Small advantages don't stay small forever. Michael doesn't notice this happening because it happens quietly. 1 year, then another, then another. No dramatic moment, no flashing warning light. Just tiny differences stacking on top of tiny differences. And that's exactly how wealth usually grows, or quietly falls behind. At this point, Michael still feels confident. He hasn't experienced a single market crash. He hasn't lost sleep over stock prices. His account balance has only moved in one direction. Daniel has experienced several uncomfortable months where his portfolio temporarily dropped by thousands of dollars. If you asked them today who made the better decision, Michael would probably say himself. Daniel might even hesitate before answering. That's what makes long-term investing so psychologically difficult. The strategy that often produces the better long-term outcome usually feels worse in the short term. The strategy that feels safest today can quietly become the most expensive over the next decade. And that's where the numbers begin to change much faster than either one of them expected. 10 years have passed. Think back to day one. Michael believed consistency would win. Daniel believed compounding would. For a long time, it wasn't obvious who was right. Now it is. Michael has continued doing exactly what he's always done. Every month, another $700 goes into his high-yield savings account. Every interest payment gets reinvested. He never misses a contribution. He never panics, because there's never been anything to panic about. His discipline deserves respect. Without consistent saving, none of this works. By year 10, Michael has contributed a total of $84,000 through monthly deposits, in addition to his original $50,000. Assuming savings account rates averaged roughly 3.5% over the decade as interest rates moved through different economic cycles, his account balance reaches approximately $167,000 before taxes on interest. That number feels substantial. Because it is. Most households would love to have that much liquid cash. But now ask a different question. What did that money have to give up to get there? Daniel hasn't changed his strategy either. His emergency fund remains parked in the same high-yield savings account. It's still boring, still predictable, still serving exactly one purpose. Everything beyond that continues flowing into his diversified investment portfolio. During these 10 years, the market doesn't behave politely. There are years when headlines predict recessions. Years when investors believe technology stocks are finished. Years when inflation dominates every financial conversation. There are corrections, recoveries, record highs, unexpected declines. At one point, Daniel watches his portfolio fall by more than 20% from a previous high. For several months, Michael can't understand why anyone would voluntarily experience that kind of stress. But Daniel doesn't sell. He keeps investing, every month, exactly the same amount, because falling prices mean his new contributions buy more shares. That's one of the strange realities of long-term investing. The years that feel the worst often become the years that matter most later. By the end of year 10, Daniel's combined assets have grown to approximately $238,000. Michael has about $167,000. The difference is now roughly $71,000. Now we're talking about real money. That's enough in many parts of the country to cover a college education, or a sizable down payment on a home, or several years of retirement income. Yet nothing dramatic happened. No lucky stock pick, no cryptocurrency explosion, no options trading, no secret investment newsletter, just different jobs assigned to different dollars. This is the flip point. For the first several years, Michael could honestly argue that certainty was worth giving up some upside. Now that argument becomes much harder to make, because the opportunity cost has become visible. Remember that phrase, opportunity cost. It's the return you never see because your money was somewhere else. It never appears on a bank statement. Your bank doesn't send you an email saying, "Here's what you could have earned." Instead, opportunity cost hides inside the future. And that's why it's so dangerous. Now let's fast forward another decade. 20 years. Michael is 52 years old. Daniel is 52 years old. Same careers, same salaries, adjusted over time, same monthly saving habit. Neither suddenly became wealthy. Neither inherited millions. They simply stayed consistent. Michael's savings account has continued earning interest through changing rate environments. Some years rates were attractive. Other years they barely stayed ahead of inflation. After 20 years of disciplined saving, his balance reaches roughly $335,000 before taxes, assuming long-term average savings yields and uninterrupted monthly contributions. Again, that's not failure. Far from it. A person with $335,000 saved has done something many people never accomplish. The problem isn't the amount. The problem is what those same dollars might have become. Daniel reaches the exact same point in life. His emergency fund has always remained available. His investment portfolio has survived every correction, every scary headline, every election, every recession fear, every prediction that this time is different. His combined assets now approach approximately $670,000, using historical long-term market return assumptions rather than perfect annual performance. That's a gap of roughly $335,000. Michael didn't lose $335,000. That's important. No one stole it. He simply never gave those dollars the opportunity to grow differently. On paper, his savings account worked exactly as promised. It protected principal. It paid interest. It stayed liquid. Sounds great, until you subtract everything else. Inflation, taxes on interest, lower long-term yields, the lost power of compounding. That's where the real cost appears. And here's something even more surprising. Let's say Daniel experienced terrible timing. Suppose the market declined sharply right before year 20. Even after a significant correction, history suggests that a diversified portfolio held over multiple decades has often still outperformed cash savings over comparable long-term periods. Not every time, but often enough that financial planners continue emphasizing long-term investing for long-term goals. Notice the wording, long-term goals. That's the key, because none of this means high-yield savings accounts are bad. Far from it. They're excellent at protecting money you'll need soon. Buying a house next year, building an emergency fund, covering unexpected repairs, preparing for a job transition. That's exactly what they were designed to do. The mistake happens when people quietly extend that timeline. 1 year becomes 3. 3 becomes 7. 7 becomes 15. Suddenly, retirement money has spent decades sitting in an account designed primarily for stability instead of growth. That's a completely different risk. Most people think risk only means losing money, but there's another kind of risk. The risk of never growing enough. Imagine reaching retirement with twice as much certainty, but half as much purchasing power as you could have had. That's a different kind of loss. A quieter one that compounds for decades without making a sound. And that's exactly why so many people misunderstand high-yield savings accounts. The account itself isn't the problem. Using it for the wrong job is. Because once you start looking beyond the interest rate and begin counting every hidden dollar that never had a chance to compound, that's the entire story changes. Here's the strange part. Almost nobody argues about the right number. They argue about the visible number. Ask someone why they love their high-yield savings account, and you'll usually hear one answer. The interest rate is 4%, or maybe 5%, or whatever the current promotional rate happens to be. That's the number everyone talks about. Almost nobody talks about the numbers underneath it. And those hidden numbers are often the ones that determine your actual financial outcome. The first hidden layer is inflation. This isn't exciting. It doesn't make headlines every day, but it quietly affects every dollar you own. If your savings account earns 4%, but inflation averages 3%, your real purchasing power only increased by about 1% before taxes. If inflation temporarily rises above your savings rate, your account balance can still grow while your purchasing power actually shrinks. Those are two very different realities. One looks good on a banking app. The other determines how much life your money can actually buy. The second hidden layer is taxes. According to the IRS, interest earned in a taxable savings account is generally taxed as ordinary income during the year it's earned. That means you don't get to choose when to pay taxes. You pay them now, every year, whether you spend the money or not. By contrast, many long-term investments held in taxable brokerage accounts allow unrealized gains to remain untaxed until the investment is sold, and retirement accounts may provide tax advantages depending on the account type and applicable rules. That difference doesn't sound dramatic, but over 20 years, allowing more money to remain invested instead of paying taxes every single year can materially increase compounding. The third hidden layer is interest rate risk. This surprises a lot of people. People often think a high-yield savings account guarantees today's rate forever. It doesn't. Banks can raise rates. Banks can lower rates, sometimes several times within a single year. Your principal is protected. Your future yield isn't. That's why looking only at today's advertised APY can create unrealistic expectations about what the next decade will look like. The fourth hidden layer is behavioral comfort. This one never appears on a statement. Michael slept well during every market correction. Daniel didn't always. That comfort has value. But comfort can become expensive when it encourages you to leave long-term money in short-term tools. The fifth hidden layer is reinvestment risk. Imagine interest rates fall from 4% to 2%. When your certificate of deposit matures or your savings account yield adjusts downward, you don't get to keep the higher rate. You reinvest at whatever rates exist then. That can significantly reduce long-term growth if lower rates persist. The sixth hidden layer is opportunity cost. This is the invisible giant. It's not a fee your bank charges. It's not a line item on a tax return. It's simply the difference between what your money did and what it reasonably could have done under a different long-term strategy. That's the number almost nobody brags about, because almost nobody calculates it. Now, if I only showed you the downsides of high-yield savings accounts, I'd be doing exactly what so many finance influencers do. I'd be telling half the story. So let's talk about where Michael's strategy actually wins. First, emergency funds. If you lose your job next month, market returns over the next 20 years don't matter. Liquidity matters. Being able to pay rent matters. A high-yield savings account is one of the most appropriate places to keep money you may need on short notice. Second, short-term goals. Planning to buy a home within the next 1 to 3 years? Saving for a wedding? Replacing a vehicle soon? Money with a short timeline generally shouldn't depend on whether the stock market happens to be up or down the week you need it. Third, people with extremely low risk tolerance. Not everyone sleeps through market volatility. Some investors panic during downturns and sell at exactly the wrong time. If someone repeatedly abandons their investment plan whenever markets fall, a more conservative strategy may actually produce better real-world results because they'll stick with it. A perfect strategy that someone can't follow is often worse than a good strategy they actually will. Fourth, retirees drawing income over the next few years. Many financial planners recommend keeping several years of expected withdrawals in cash or cash-like investments so retirees aren't forced to sell stocks during market declines. Again, different dollars. Different jobs. Now let's be equally fair to Daniel. Investing isn't magic. It comes with real disadvantages. Volatility is the obvious one. A diversified stock portfolio can lose 20%, 30%, or even more during severe bear markets before eventually recovering. That's happened multiple times throughout history. There's no guarantee your account will always be higher next year. There's also sequence of returns risk. If someone begins withdrawing heavily immediately after a major market decline, poor early returns can have an outsized impact on the longevity of their portfolio. Liquidity can also become psychological rather than practical. Yes, investments can usually be sold quickly, but selling after a sharp decline may permanently lock in losses that would otherwise have recovered over time. And then there's emotional discipline. This might be the biggest challenge of all. Successful long-term investing often requires doing something that feels completely wrong. Buying when markets are falling. Continuing to invest while headlines predict disaster. Ignoring daily noise. That's much harder than opening a savings account and watching the balance quietly increase. So when does Michael's strategy actually outperform Daniel's? More often than some people realize. If the money will definitely be needed within the next 12 to 36 months, Michael probably made the better choice. If someone knows they've lose sleep over market volatility and repeatedly sell during downturns, Michael's approach may leave them financially ahead because consistency beats panic. And if interest rates remain unusually high while expected investment returns are unusually low over a short period, the gap narrows considerably. Context matters. Timelines matter. That's why this isn't a debate about whether high-yield savings accounts are good or bad. It's a debate about matching the right financial tool to the right financial goal. There's another important fact worth grounding this discussion. The FDIC currently insures eligible deposits at FDIC-insured banks up to $250,000 per depositor, per insured bank, for each ownership category. That's a tremendous benefit. If your bank fails, eligible insured deposits are protected within those limits. Broad stock market index funds don't come with that type of deposit insurance because they have reinvestments, not bank deposits. Different protections, different purposes. That's exactly why Daniel never eliminated his emergency fund. He simply stopped asking it to build his retirement. So if you're wondering what a practical strategy actually looks like, here's one that many long-term investors use. Step 1 is simple. Calculate how much money you genuinely need for emergencies, typically 3 to 6 months of essential living expenses, depending on your job stability and personal circumstances. That money belongs in a high-yield savings account or another highly liquid, low-risk vehicle. Step 2. Separate every dollar that won't be needed for at least 7 to 10 years. Those dollars have a completely different mission. Instead of maximizing today's interest rate, focus on long-term growth using a diversified investment strategy that matches your risk tolerance and overall financial plan. Step 3. Automate everything. Set up automatic transfers for both your emergency savings and your investments. The less often you have to make emotional decisions, the more likely you'll stay consistent when markets become uncomfortable. Because consistency, not prediction, is what quietly builds wealth over decades. Now let's go back to Michael and Daniel one last time. 20 years have passed. They meet for coffee on a Saturday morning, and the conversation eventually turns to money. It always does. Michael opens his banking app with quiet confidence. He sees more than $335,000 sitting there. No sleepless nights, no market crashes to worry about, no years where his account balance suddenly dropped by 20%. He did exactly what he set out to do. He protected his savings. Daniel opens his investment account. His emergency fund is still sitting safely in a high-yield savings account, ready if life throws him a surprise. But his long-term investments have spent 2 decades doing what they were designed to do. His combined portfolio is now worth roughly $670,000 under the assumptions we've used throughout this comparison. The difference between them is about $335,000. That's enough to change retirement, enough to delay retirement by years, or accelerate it, enough to cover healthcare costs later in life, enough to create opportunities that simply weren't available before. But here's the most important part. Neither Michael nor Daniel was irresponsible. Neither one gambled. Neither one made reckless bets. Both of them saved consistently. Both of them lived below their means. Both of them cared about their future. The difference wasn't discipline. The difference was assigning different jobs to different dollars. Now let's change just one variable. Imagine Daniel increases his monthly investment by only $200. Not $2,000, just $200. Instead of investing $700 every month, he invests $900 over another 20-year period. Assuming long-term returns similar to historical averages, that relatively small monthly increase could add well over $100,000, and potentially much more, to his ending portfolio because every additional contribution also compounds over time. That's the power most people underestimate. They think wealth comes from finding a magical investment. More often, it comes from consistently giving compounding a little more to work with. Now imagine the opposite. Suppose interest rates fall back to levels closer to those seen during much of the 2010s. Michael's future interest earnings decline. His savings remain safe, but the engine producing new growth becomes much smaller. Again, that's not a flaw. That's simply how savings accounts are designed. They're built to preserve capital and provide liquidity, not to maximize long-term growth. This entire conversation comes down to one question. What job are you asking your money to perform? If you're asking emergency savings to protect your family, a high-yield savings account is an excellent tool. If you're asking retirement savings to grow over the next 20 or 30 years, history suggests that relying only on a savings account has often come with a significant opportunity cost compared with diversified long-term investing, despite the additional volatility. Those are completely different objectives, and confusing them can become incredibly expensive. One final point deserves attention. Nobody knows what markets will do next year. Nobody knows exactly where interest rates will be 12 months from now. Nobody knows when the next recession will arrive. That's why successful financial planning usually isn't built around predicting the future. It's built around preparing for multiple possible futures. Cash protects flexibility. Investments pursue growth. Insurance protects against catastrophe. Each tool has a purpose. Problems usually begin when we expect one financial product to solve every problem at once. Michael and Daniel both walked away on day one, thinking they made the smart play. Michael believed safety automatically meant the best financial decision. Daniel believed investing alone was the entire answer. Neither one had actually run the full numbers, because the real lesson was never high-yield savings accounts are bad, and it was never invest every dollar you own. The real lesson is that financial products should be matched to financial timelines. The real trap isn't a high-yield savings account. The real trap isn't the stock market. The real trap is making the decision based on hype, headlines, or someone else's opinion instead of running the numbers for your own situation. That's what separates financial confidence from financial guesswork. The numbers don't care about opinions. They don't care about social media trends. They don't care what your neighbor, your coworker, or your favorite influencer says. They simply reflect the choices you make, repeated over time. And once you start looking at money that way, every financial decision begins to change. The account you open, the debt you take on, the investments you choose, even the cash you decide to keep on the sidelines. Because every dollar has a job. Your job is deciding whether you've assigned it correctly. And if you're wondering what happens when someone combines high-yield savings, treasury bills, and long-term index investing into one complete strategy, that's a completely different conversation. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day, so you can make smarter decisions with your own money, not someone else's opinions. Until next time, keep asking better questions, keep running the numbers, and remember that the smartest financial decision is rarely the loudest one. It's usually the one that quietly keeps working long after everyone else has stopped paying attention.